Hello. In chapter one, we discussed the accounting equation as well as accounting transactions, and we've seen some accounts that a lot of companies use, and we've seen how we use those accounts to record transactions. We reflected them on the accounting equation using pluses and minuses. So, for example, when we issued stocks for cash, we did cash plus, for example, $100,000 and common stock increases by $100,000. We did a plus and plus for both accounts. In accounting systems all over the world, the technicality is the same in terms of pluses and minuses, but we never say plus and minus. We normally use debits and credits instead of saying plus and minus, increase and decrease. Now, which one is the plus, which one is the minus? Is the debit the plus or is the credit the plus, and how does it work? Now, the answer for that is it depends. Not every time the debit means a plus or the credit means a plus. It depends on the account. The account will decide if it increases with a debit or it increases with a credit. So here's a quick orientation on what is being increased with a debit, which accounts being increased with a debit, and which accounts being increased with a credit. If we look here, assets equals liabilities plus owner's equity, stockholders' equity. The assets, any account that falls under the assets, like cash, like buildings, like supplies, like prepaid, like accounts receivable, any of those accounts will increase with a debit. Okay, so if we're increasing it, it means we're debiting it. And if it decreases, it will be a credit. So debit and credit are always opposite each other. Okay, that's if they are assets. The other side of the equation, liabilities as well as the stockholders' equity, those will increase with a credit. Any account that falls under either liabilities or stockholders' equity, like accounts payable, notes payable, common stock, retained earnings, all those will increase with a credit. That means they decrease with a debit. Okay. Now, when it comes to expenses, dividends, and revenues, expenses and dividends, they work the same way as assets. They both increase with a debit, same like assets. So if we distributed dividends or if we paid for an expense, we will say that we debited the expense account. If we pay dividends, we will say that we will debit the dividends account. Revenue works same like liabilities and stockholders' equity. It increases with a credit. So if we say that we provided a service to a customer, that means we have revenue here. That means we increased our revenue. That means we are crediting the revenue account. So every time when we start recording the transactions, we're going to use debits and credits instead of plus and minus. Now, the official way in accounting to record transactions is using debits and credits. We do something that we call it a journal entry. A journal entry is always going to have at least two accounts affected in it. I mean, it's just a recording. It's just the official way in recording a transaction. So we know that it has to be at least two accounts every time. And then the other thing that we need to know is one of these accounts will be debited, the other one will be credited every time. They might be both increasing. Both accounts might be increasing, or both accounts might be decreasing, or maybe one of them is increasing, the other one is decreasing. No matter what the situation is, it's always going to be one of the accounts debited and the other one is credited. Or we might have more than two accounts, but we will still have some of them debited, the other ones will be credited. Always, you're going to have both debit and credit. So let's go back to the same transactions that we recorded in chapter 1, but this time we're going to use debits and credits, and I will show you how the journal entry looks like when we record it. Now, first of all, before you record a journal entry for any transaction, in our head, we can think in 3 steps. So let's take a look here at the 3 steps. Step number 1, after you look at the transaction, think what accounts you need for this particular transaction. choose the accounts. The second step is to decide which one of these accounts is increasing, which one is decreasing, or maybe both are increasing, both are decreasing. Okay, so decide the accounts and then decide the increase and decrease. Step number 3, based on what we learned here, we have to decide if that account has to be debited or credited. It's based on where that account is classified. If it was an asset account and we know that it's going to increase, that means we're going to debit that account. So we will use the formula that we have here on the right side. Okay, so let's go back to those transactions. The very first transaction we did, it was issuing common stock for $100,000 cash. That means the two accounts affected in this transaction is cash as well as common stock. So remember, the first step is to think what accounts we need. The accounts are cash and common stock. That's step number 1. Step number 2, decide the increase and decrease. If I'm going to issue stocks and get cash, the company's cash will increase. So the cash will increase, and then the common stock is also going to increase because there was no common stock at all, and now there is common stock. So both of them will increase, cash as well as common stock. Step number 3, we have to decide which one is debit, which one is credit. Now, think where each one of them is classified. The cash is classified as an asset. We know that. It's one of the company's belonging and it has a value. So it will increase with a debit. So the cash will be debited. The other account is the common stock, which is a stockholders' equity account. We know that stockholders' equity increases with a credit. So common stock will be credited. So cash debit and common stock credit. So I'm going to record that transaction in a journal entry. The other thing we need to know is we always have to start with the account that we're debiting first. Never start with the credit. You always have to start with the debit. So here, I'm going to write debit. And this is normally how we write debit in accounting. DR. I mean, the word debit does not have an R, but the DR came from a Latin language, so it's just very common in every accounting system in the world that debit, DR stands for debit. So remember, we're going to debit the cash. So I'm going to say debit cash, and the amount is $100,000. So I'm just going to write down the amount. And then once I'm done with the debit, then we can start with the credit. So credit, CR. Leave a space. Leave, like if you're on a computer, when you click on a tab, and it gives you about 1 inch space. So that's what we should do every time we record the account that we're crediting. Okay. So I'm going to leave a space, and then I'm going to write down common stock $100,000. I just finished recording our first journal entry. So in chapter 1, we've seen how cash and common stock will be reflected on the accounting equation. We've seen that the cash goes under the assets and common stock under the equity. And now we're doing kind of the same thing, but we're recording it in a different way. We're recording it using the official method in recording recording transactions, which is journal entries. So that was the first one. Okay. Usually we write an explanation underneath it to explain what that transaction is. So I'll just skip that part. Okay. Now let's record the second journal entry. The second transaction, it's purchasing equipment for $20,000, and we got cash for that. Okay. Now, again, what are the 3 steps? Step number 1, to decide what the 2 accounts are, and then there might be 2 or more, but for that transaction, that particular one, it's only 2. We purchase equipment for cash, so we're spending cash, we're paying cash, so our cash is decreasing. And then the other account is the equipment, which is another asset, but this time we're increasing. So cash decreases and equipment increases. Step number 2, decide Step number 3, decide the debits and credits. I already know what the accounts are, and then I know which one is increasing and decreasing. So now think where these accounts are classified in the equation. We know that both of them are assets. So if it's going to increase, it is going to be a debit. So the equipment is increasing, that would be a debit. Cash is decreasing, cash is an asset, so asset decreases with a credit. That means cash will decrease with a credit. Okay? Remember, when you record the journal for that, you always have to start with a debit first. So debit, equipment, $20,000, and then credit, cash, $20,000 as well. Okay? Remember that I'm keeping a space before the account that I'm crediting. Okay? All right, that was the second one. Now the third one, purchased supplies for $1,000 on account. Now, we discussed before that the word on account, it means we have to think about either accounts receivable or accounts payable. It means that there is something that we're either purchasing on account or we provide a service on account. So either we will expect money to be received or we will expect money to be paid soon. So that's what on account means. In that example, we're expecting to pay an amount of money in the future because we're purchasing on account. We don't pay now. We receive the supplies now, but we're not paying now. We will pay in future. So in that case, what accounts do we need? We need the supplies because supplies is increasing. It's coming. We're buying it. And then because we're not paying cash, so instead of thinking about cash, we're going to think about the accounts payable account. It's a liability. So if I'm going to buy supplies and not pay now, I will pay in future. That means I'm liable to pay money in the future. That will make it accounts payable. So remember, supplies is increasing and accounts payable is also increasing because what I'm trying to say is what we owe is increasing. Okay? So both of them are increasing. Now, which one is debit, which one is credit? We always have to have a debit and a credit. The supplies is an asset. It's increasing, so that will be a debit. So I'm going to say debit, supplies. We always have to start with the account that we're debiting. Do not start with the account that you're crediting. Always start with the debit first. So supplies, let's say that was a $1,000. And then credit, the other account is the accounts payable. Accounts payable increases with the credit as per the accounting rules. Okay? Any liability account increases with a credit. So accounts payable. Remember, when we write down A/P, it means accounts payable. $1,000. Okay. One more. And then before we continue, always try not to overthink it. Because a lot of students, they do mistakes because they overthink the stuff. And then what I noticed from some of the students, they try to link debits and credits to debit cards and credit cards. Or they try to link it with something they know in their life that is related to debits and credits. So try not to overthink it. Try not to relate those debits and credits to anything else. Just think in 3 steps. What accounts, increase, decrease, and debits and credits based on the formula we have. If it is an asset, it increases with the debit. If it's liability, stockholders' equity, that will be increased with the credit. That's it. Don't think more than that. Okay, transaction number 4, provided a service for $4,000 and got cash for that. The 2 accounts are cash and service revenue. We're receiving cash, so cash is increasing. Cash is an asset, so cash will be debited because it's an asset. Asset goes up with the debit. The other account is the service revenue. We know that service revenue increases with a credit, so I'm going to debit cash and credit service revenue. So debit cash for $4,000 and then credit service revenue $4,000. Okay. All right, and then next, provided a service for $3,000 on account. This time we're providing a service, but we're not getting paid immediately. We will pay. We will get paid in the near future. So we will say that the revenue is increasing because we finished providing the service. It's done. In accounting, we say it has been accrued. It's done. So it's officially considered a revenue, so it has to be officially recorded, but we cannot increase the cash because we did not get cash yet. Instead, we're going to think about the accounts receivable account instead of thinking about cash. So accounts receivable means that there's money owed by someone to us. And it's an asset. Accounts receivable is an asset. So accounts receivable is increasing because the amount owed by someone to us is increasing. So accounts receivable goes up. It's an asset, so it will be debited. So debit accounts receivable, always start with the account that you're debiting first. $3,000, and then credit to service revenue, $3,000. Okay. And by the way, usually you record those transactions on daily basis. So you normally show the date for every transaction, but we're skipping that part. But in real accounting systems in everywhere in the world, there's always a date for every transaction. Okay. Now, let's record one more. Paid $500 for advertising. When we pay for advertising, we consider that an expense because advertising is one of the operational activities that any company will do. It costs them money, but that's for helping the business to operate, maybe to sell more, maybe to get more awareness in the market about the products. So we paid $500 for advertising. Advertising is an expense, so our advertising expense account will increase by $500, and then our cash will decrease by $500. So an expense account will increase with a debit, because that's what we know from the formula here. And our cash will decrease, which is an asset, so that will be a credit, because assets decrease with a credit. Okay, so debit, advertising expense, for $500, and then credit, cash, $500. Okay, now those are the journals we recorded. Those are the transactions we recorded in chapter 1. So this time I recorded them in journal entries. I have 2 more transactions to record, which we did not do in chapter 1. The first one is paid $1,200 in advance to cover 1 year of rent. Now, if you pay in advance for like rent or insurance maybe, and then it's going to cover a long period of time, you're not going to consider that you consumed that amount already the day you paid for it. It will be consumed over time, over 12 months in our example. So we're not going to consider that an expense immediately. We will consider it a prepaid account first, which is going to be an asset account. And later on, once you start consuming it, then at that time, you will transfer it from the asset account to an expense account. But as of now, because we prepaid it, we're considering it still our money. We still have some holding value there. So we're going to consider it an asset. So the 2 accounts to think about are cash, which is decreasing, and prepaid rent. Prepaid rent is an asset. It increases. So that would be a debit. So I will say debit, prepaid rent, $1,200, and then credit cash $1,200. And then one more transaction, receive $2,000 cash in advance for a service that will be provided next month. Now that's an account that we will use, an account that is new to us, we didn't use before, and it's called Unearned Revenue, which is a liability account. It's technically opposite the prepaid rent or prepaid accounts. The prepaid rent, we paid money in advance. The unearned revenue, we will receive money in advance. Okay, so both of them are in advance, but one of them is paying money, the other one is receiving money. So when you receive a money from a customer and you promise him to provide him a service sometime in future, because we did not provide him the service yet, so we cannot say debit cash and credit revenue. We're not going to credit revenue because we did not provide the service yet. We will still be debiting cash, but we're not going to credit revenue because we did not provide him the service yet. Instead, I have to come up with a different account, which is a liability account, and we call it unearned revenue because that revenue hasn't been earned yet because we did not provide it yet. Okay? And it's considered a liability account because we're still liable to provide the service to that customer soon because he already paid for it. Okay? So the two accounts are cash and unearned revenue. Cash is an asset, so it will increase, which is going to be a debit. So debit cash for $2,000 and then credit unearned revenue $2,000. It's a liability, so it increases with a credit. Okay, and so that's it for this video. In the next video, we will talk about the next step in our accounting cycle, which is T accounts and trial balance, and then preparing the financial statements. Thank you.